Andy Agathangelo, the founder of the Transparency Task Force. The Transparency Task Force is a certified social enterprise, which means that we exist to make an impact and not to make a profit. Our purpose, our mission statement, our formal mission statement is to promote ongoing reform of the financial sector so that it serves society better. We believe that the financial sector is profoundly important to the well-being of society, to economic stability and to political stability as well. But we also believe that the financial industry has a propensity to misbehave if given half a chance. And history has told us many times over that if you give the financial industry a chance to misbehave, it will. That's why, of course, the regulatory framework that governs the sector is remarkably important. It sometimes does that really well, and sometimes it doesn't do it very well. Tonight's session, as you all know, is entitled "The Catastrophic Regulatory Failure Around LDI in Pensions," LDI being liability-driven investing, and its parallel universe counterpart of interest rate hedging product mis-selling by the banks. These might seem like two seemingly unrelated topics, but they are joined in a Venn diagram-like manner. The overlap between the two circles, one circle being LDI, the other circle being IRHP, is the nature of the derivatives, the nature of the instruments at play. And what we believe in the Transparency Task Force is that when trustee boards bought LDI solutions, they may well not have known the full risks associated with what they were buying. Question, were they missold? Certainly in relation to interest rate hedging products, we know for sure, because there's a pile of evidence, that many business owners bought derivative-based products that were not properly disclosed, which went on to cause extreme detriment. Thousands, I'm not exaggerating this, thousands of businesses ended up being put into a state of financial collapse because of the nature of the investments that they were missold. And we also have within the Transparency Task Force, this session is being recorded, I'm going on record, we have hard evidence of fraudulent mis-selling. In other words, the deliberate concealment of meaningful evidence that the customer should have been privy to before making a decision to buy. And frankly, even worse than that, after the mis-selling took place, we have evidence of cover-up and collusion. This is really serious stuff. I'd like you all to think about how you feel when you become aware of something that is grotesquely unfair, something that is a miscarriage of justice. That is exactly how the Transparency Task Force feels about the interest rate hedging product mis-selling by the banks. Over the last 6 or 7 weeks, because of the publicity around the Bank of England's emergency interventions, the issue of hidden credit margin has been coming to the surface. So the LDI story that's been unraveling over the last few weeks is helping to shine a big, bright light on the rather suppressed story of interest rate hedging product mis-selling by the banks. And I should mention as well that on December the 13th, the Transparency Task Force has an event where we're going to be lifting the lid on the Business Banking Resolution Service, something that was created supposedly to provide an independent means of compensation, redress and justice for the business owners. We have evidence that would suggest that the Business Banking Resolution Service simply is not fit for purpose. So allow me to bring things together before passing over to Con Keating by basically saying we're talking about two separate topics, LDI in pensions and IRHP in banks, joined by the nature of the derivatives within those inverted commas solutions. and a huge question mark over all of it. Has there been catastrophic regulatory failure? And I'm happy to go on the record to say that in my opinion, there most certainly has been in both cases. Quite a few of you have been involved with the TTF for quite some time. Con Keating is quite literally a person who's played a part in helping the TTF to exist. I have very, very fond memories of leaving a professional pensions event at the QE2 Centre in London and seeing Con at the exit about to light a cigar. Do you remember this, Con?
Yep.
Okay, there he was about to light a cigar. Con had been one of the keynote speakers at the session. I loved the chance of having a chat with him, so we sparked up a conversation. And the conversation that Con and I had at that very moment, which was completely unexpected and unsort of planned, led to a meeting between myself and Con Keating and Chris Sear. That conversation was very, very memorable because it led to the creation of the idea of some force for good within the financial industry that would be a sunlight is the best disinfectant agent for change within the industry. And many, many years since, I'm very pleased to say that TTF has been growing from strength to strength to strength. So Con, you're especially welcome here today to be our keynote speaker. Quite literally, Con, if it weren't for you, the TTF would not exist. You know how grateful I am for that. I'm also remarkably grateful that in Con we have somebody with extraordinary knowledge and insight. He always speaks truth to power. He always tells it exactly as it is. He takes no prisoners, and I've learned over the years to very, very attentively listen to what Con says. I hope you really enjoy this part of the session. Con's going to be speaking, including with Q&A, up until about 7 p.m. Then from 7 o'clock-ish, we'll start talking about interest rate hedging product mis-selling. I should also mention, I'm particularly pleased that we have Baroness Bowles of Berkhamsted here with us today, maybe one or two other parliamentarians joining us as well. And we've also got some members of the press too. I think that's a good reflection of the importance of the topic that Con is about to be speaking at. So, Con, we now get to the really difficult bit, which is sharing your slides. So if you, number one, click on share screen.
Okay.
That's it. And click on your share screen. Remember, you made your Zoom screen.
Yeah, I clicked on the shared screen, and I've got a choice of things to click on next.
Yeah, so click onto your PowerPoint slides.
Can you see them?
Not yet, they'll come through in just a moment, I'm sure. Let's try the process.
Wait a moment, I have to click share, I think.
That's it. Lovely. So far, very, very good, Con. All yours, sir. Can we just show our appreciation for Con just as about to start the session? So, Con, thank you very, very much indeed. Thank you. Thank you.
Thank you. Well, I hope you can all see this first slide. I thought a cartoon was the most appropriate way to begin this, if only because this may be the only laugh you get in the course of the evening. It's a classic piece of gobbledygook coming from an investment banker to a client. And I think that there's an awful lot of this has gone on with respect to LDI and how can I put this, less experienced trustees, less financially educated trustees. I think this has driven things rather heavily. So let's go forward straight away just to remind people what happened. This is a Bank of England chart. It shows the evolution of the 30-year gilt through the period in question. In other words, from shortly before the Bank of England last increase in rates, followed by that economically illiterate budget speech, mini budget speech by Kwasi Kwarteng, and then the spiral that the reaction to the bank and the mini budget prompted. That spiral comes about because of a particular form of liability-driven investment called leveraged LDI. And that uses principally repo and interest rate swaps to lever a portfolio for a number of reasons, which we will come on to in the course of the evening. So LDI is the topic. Let's go on to the next slide. The first thing to realize is this could have been predicted, was predicted. It was almost certain to arise. The thing which we are being asked to believe by many of the proponents of LDI to this day is that these were exceptionally large moves in markets. The answer is the events which triggered the spiral of collateral calls and forced selling of gilts by pension funds basically were not that great. If you have here a listing by day of returns on two index-linked gilts, a 14-year and a 17-year, and a 15-year zero coupon gilt. These are Bank of England figures and Tradeweb figures, absolutely reliable. The first thing to notice is that on the day on which the bank announced that it would be selling 80 billion of its QE portfolio and increase rates by, I think that one was 0.5%. We saw the 15-year conventional gilt fall by 2.57% in price. That's not a particularly large move. We've seen those on many other occasions, but what is interesting, excuse me, what is interesting is that there is no movement on the day of the bank rate increase and the announcement of the sale of the QE portfolio, all of which, of course, is conventional. There is no movement at all in the index-linked market. Now, the index-linked market is absolutely dominated by pension funds. UKDB funds at this point in time probably own somewhere around 85%, maybe more, of the outstanding issues of linkers. So in response to the bank rate increase, they did nothing. And we saw a market correction in reaction to the increase in bank rate and the sale of gilts being announced, which is quite interesting. It suggests that the conventional market was febrile, but that linkers weren't particularly so. Then we have next to that, the next day, which is the day of the mini budget, the Thursday. And we see linkers falling heavily, 3% in the 14-year, 3 and a bit percent in the 17-year. And the conventional is down by the same sort of price as it had been the previous day. So we have a total decline of 5%, but we already saw linker sales on the day of the mini budget, which I think is rather important because the only people who can be selling linkers at that point in time really are pension funds. Then on the Friday, we have the beginnings of hell breaking loose. Larger moves down in both linkers and conventionals. Okay. The spiral of LDI selling in order to raise cash to meet collateral calls is well underway. and having quite marked effects on both linker and conventional prices. Over the weekend, time to think about it, Monday morning, and all hell breaks loose in the linker market. Yeah, on that Monday, we lost almost 5% in conventional prices, and we lost far more in linkers. Linkers are, in fact, just like conventional gilts on steroids. And there are technical reasons for that, for them to be slightly more volatile, but not as volatile as they are. The volatility in the linker market is a product of the concentrated ownership in the pensions world. And the pensions regulator and all and sundry have been aware of this concentration almost since the time when linkers were first issued. If you remember, the first linkers issued back in the 1980s were specifically targeted at pension funds. The next day, same again, and in linkers, worse. Not quite so bad in conventionals, but still a 5% move is pretty exceptional. At this point, we are now down by 15% or so relative to the pre-Bank of England level. The collateral calls are beginning to become quite severe. The Wednesday morning, it was more of the same until the bank intervened. And then we see an incredibly strong rally in conventionals, which of course is the only thing that the bank was operating in at that point in time. But we also see marked improvements in linker prices, more so than in the conventional market. So in the course of that day, some pension funds had to be buying linkers. Okay, so I think that this was a triumph of hope over experience, although subsequently, of course, the bank did decide it would intervene in the linker market. So how severe was this? A day, perhaps 2 days of 2.5% declines triggered a doom spiral, the endogenous risk of prices go down, so you have to sell assets in order to meet the collateral calls, and this drives prices even more crazy. We've seen it before. We saw it in the US mortgage securities markets. I'll give you another comparison later as to why we should have been looking for and expecting this. Could this behavior of the spiral being triggered have been predicted? Well, it was absolutely certain. Once you reach a point which is sufficiently large, and in this case, it wasn't very large, somewhere between 2.5% and 5%, then this spiral was bound to kick off. So let's do away with the idea that this is a black swan event. It is not. It was certain to happen at some point or another. So there's a couple of lines just saying what we said there rather more succinctly. So let's just explain a technicality to you, which is what we need to get to is not the death spiral associated with linkers. That was driven by leverage. Sarah Breeden and the Bank of England were right in saying it was mismanaged leverage, but that's what created the gilt crisis. The question is, why were pension schemes, why are pension schemes using liability-driven investment? And the answer to this lies in an accounting standard and regulatory valuation processes. And I just want to illustrate to you the nature of that problem with a highly stylized diagram. We have a pension here, which is a single lump sum of 100. And we have a contribution for it today, which is 14.2, not that the numbers actually matter. And this is the, if you like, correct rate of amortization of that contribution to pay that pension. This is what should be considered to be the appropriate rate at which to fund that obligation. What we have is, in fact, something very, very different from this. We have a linkage to market prices. It is the yields in the gilt market which are being used to value liabilities. And we've had claims that this has had dramatic effects because liabilities have gone down as rates rose, and so there was nothing to worry about and nothing to be seen here. I'll get to discussing those arguments later. What I want to show here is just what happens when you introduce a market rate. This is a market simulation. It has a trend. This particular line, these sequence of dots, are a market rate which starts at 8% and declines. And you will see that, first of all, it's all over the place. And secondly, that it catches up to the other line, so that if you were to be using a market rate here, you would start having relatively low funding requirements, and that these would come to bear progressively over time and would make your scheme seem all the more unaffordable. This is another market sequence with no trend. This has the same 5% yield that is implicit in the underlying contract that I constructed. And you can see what the effect of market valuation is. Those which are above the line are demands for extra funding. Those which are below would be showing surplus. Then we have the opposite case, which is where we see rates start at 2 and fall to 8 over the course of the period, so averaging 5. And we see excess demands for funding at the beginning when rates are low, and lower demands for funding later in the course of the development of this pension obligation. The point is, and the key point to take away from this is very simple. The rate at which we amortize this pension does not affect the pension. Okay, that's a major point to understand. It is not a risk to the pension. It is a risk, and it is the cause of variability in the intermediate valuations, but they are not in and of themselves a risk of the pension. And this is terribly important for trustees, because trustees' requirements and trustees' obligations are with respect to the payment of the pensions. You could argue, and I suspect that some lawyers will, that hedging the interest rate on these grounds alone is ultra vires for pension trustees. So this is just some words which say what I have just said. The point that I want to make here is that the correct accounting standard is that one which I showed, which is the rate of return required on the contribution to meet the projected benefit obligations. That rate is inherently invariant, and it only changes if you change the expected benefit payments, or the benefit payments themselves prove to be slightly higher than originally, or somewhat higher than originally projected. So Now, I just want to show you what LDI is doing. We have a valuation at some point in the life of the scheme, and we have a set of assets valued at market prices. We have a set of liabilities valued as a discounted present value using a market-based rate. Okay, so to look at the comparison is you're talking about mixed attribute. The basis of calculation of the assets and the liabilities differs. So now LDI was concerned with matching assets to liabilities. Not contrary to what had been said by many of the people who have been speaking in Parliament, this is not about cash flow matching. This is about matching the variability of the assets and their associated liabilities. It's not a cash flow matching exercise per se. And most of the variability in that actually comes from variability of discount rate. Now, the first point to note here is schemes were 2004, 5, 6, 7, through most of the past 20 years, by and large in deficit. So I've shown here assets being less than liabilities. That means that you have to have riskier asset profiles than you do have liabilities. Otherwise, you're never going to be able to match the volatility of your liabilities with the volatility of assets. Subsequently, a second objective was introduced, probably not until the 2008, 9, 10 period, really, maybe earlier than that, 2007 perhaps. And that was to use the assets also to repair the scheme deficit. And the requirement then becomes, well, in order to earn more money, the scheme's assets have got to become riskier. So this is an inherently risky strategy. In trying to match the variability, you are forcing your assets into a riskier position than you might otherwise. If you are trying to match the and repair the deficit with asset performance, you're going to make them even riskier still. Now, the way to square those two objectives was not to try doing it with riskier and riskier assets directly, largely because that would be transparent and would have almost certainly have resulted in some catastrophic failures. The way chosen to actually meet that objective was to lever the portfolio and to subdivide your portfolio into matching and growth sub-portfolios. Just a matter of convenience there. And leverage was introduced using two instruments, interest rate swaps and repo. And we'll talk about those at length. Now, you can think in terms of traditional asset and liability management, of which many of the exponents of LDI claim that that is. And here we see a traditional business. It has equity, it has debt, it has business liabilities, and it has a collection of business assets. The whole point about asset and liability management is it is concerned with protecting the company's equity. And it's about protecting the company's equity from the aggregate risks of assets and liabilities. And we'll talk about some of those behaviors later. Note that here, unlike the pension arrangement we saw earlier, the assets, the green bar, are larger than non-equity liabilities. With which in mind, you can leverage the balance sheet if you want. You issue more bonds, you have more assets as you invest the proceeds of those bonds. The point is, with a surplus of assets to liabilities, we can easily match the non-equity liabilities with assets and have a surplus to pursue growth and the development of the business. The key difference between the company and the pension scheme, and between LDI and the company, is the absence of any explicit equity in the pension fund. Now, the sponsor, the company sponsor of a pension scheme, stands behind the scheme. It made the promise. It is liable to make good any shortfall in the asset portfolio. But the pensions regulator has never had much regard for sponsor covenant. They regard the sponsor covenant as being an albatross around the neck of the pension scheme, not as being an asset of the scheme. In fact, Alan Rubinstein, who was CEO of the Pension Protection Fund, summarized it all rather well back in 2011, when he said, "Funding trumps covenant," meaning I want to see money within the fund, and I don't really care how strong the employer is. I think that's just the height of folly. Andrew Slater, who I was working with at the time that was said, there's a lovely analogy, Con. You should simply say, we'll rephrase this as seatbelts trump brakes for cars, for driving. And of course, it is precisely that. The point about the regulator is they don't consider the sponsor covenant to be an asset of the scheme. So let's just look at the holistic position, which is what should be being done. Okay, we have the pension up at the top. We have the company's accounts. We have the pension scheme's accounts. We commingle them in the middle, and you'll see that there is a proportion of equity which supports the pension deficit. That's really the easiest way of explaining what's been wrong with the regulatory approach since the very inception of the pensions regulator. What we should be concerned with is equity exposure to corporate debt, business liabilities, and pension liabilities, and company assets and pension scheme assets. And there are many intrinsic counters to this. For example, we are hedging interest rates with LDI. Now, what that means is we are going longer bonds in order to gain as rates go down. Well, I have news for you. As rates go down, companies make more money naturally. We all tend to spend more money. Companies tend to be more profitable. There is an intrinsic hedge within the company and pension scheme structure, which is being completely ignored by the regulator. It goes beyond that. For example, schemes are, as part of LDI, people are hedging inflation using index-linked gilts mainly. The actual exposure of a pension scheme is to limited price inflation. Most schemes are not obliged to give increases above 5%, and some it's actually no increases above 2.5%. There are exceptions to that, but those are the general rules. Now, a company which is experiencing times of high inflation, in times of high inflation, then interest rates are also high. So if you consider hedging interest rates and limited price inflation, you will find that you don't actually want to hedge limited price inflation. The limited price inflation is cost containment in a high-priced, high-yield environment. It actually works in favor of the company's profitability. So, I can't actually read as I said earlier, interest rates don't figure in the determination. They just determine trajectory or amortization. So interest rate risk is not real, it's perceived. It's about variation in valuations from time to time. These rates determine the present value, as I've explained. In and of themselves, that variability does not matter unless we take action upon them. Okay. If we were simply to let them pass unattended, then we would get to where we want to be, and that would be the end of it. If you do start hedging using conventional gilts, let's keep it to the simplest possible level, you are actually introducing a sensitivity to interest rates. You are effectively long gilts, long-dated gilts in your pension scheme. So as long as rates decline, you do well. And for 20 years, schemes have done well out of LDI. And of course, when rates start rising, you lose money. And that we have just seen, and the consequences can be catastrophic. Schemes gain when rates decline, lose when they rise. Perhaps the ultimate damnation of liability-driven investment is this. The variability doesn't matter unless we base actions on them. Liability-driven investment is basing all of our investment actions on them. It is the ultimate folly. Not a factor. Well, there's the question of whether that is legal for trustees. It is not a determinant of the ultimate benefits. TPR, of course, bases their deficit repair contributions on precisely those valuations. If it were a question of the company being uncomfortable with the interest rate exposure, which is inherent, we would expect to see some companies hedging those interest rates, and none have done it. The only place where it has actually happened has been within the pension scheme. Now, hedging is done in two ways. It's either done through pooled funds or segregated accounts. Pooled funds have limited liability and may borrow. Okay, any mutual fund has the ability to borrow. There may be degrees of limitation on it, depending on where it's incorporated and so on, but limited liability and the ability to borrow. In the pooled funds, we saw some fairly extreme leverages, 4 times, 6 times, and there are apocryphal stories, I hope, of even higher levels of leverage within those funds. The idea is that the pension scheme can put a minimum amount of money into this fund and get the same bang as a large amount of money. It's otherwise known as outright speculation, and it's, of course, exactly what most hedge funds were set up to try to achieve. They would also repo gilts, repo some of the gilts they own, some of the cash gilts, and with the proceeds of the repo, go and buy some more gilts and lever that way. The interest rate swap that is standard is fixed receiver. That's to say, the scheme receives a rate of interest, 2%, 3%, 4%, whatever, fixed for some term, 20, 30, 40 years. And against that, the pension scheme has to pay the short rate, the 6-month SONIA rate, used to be LIBOR, And that is the basic nature of an interest rate swap. I'll talk at some length later about the risks inherent in that, but you also have now collateral calls on gilt repo, which actually only was introduced after the 2008-9 crash. So you can get collateral calls coming in from your interest rate swaps and from your repo as bond prices go down, and particularly pernicious in the case of interest rate swaps as the short rate rises. So the immediate thing here is the pooled fund is immediately concerned with the immediate, paying next short rate, the 6-monthly rate, and meeting any collateral calls arising from variation in the gilt price. And in a leverage position, this is really, really explosive stuff. So now here's a worked example. Suppose we have a fund which is allowed to gear 4 times. So we put £20 of capital in, we buy then 100 gilts, okay? And we do this using repo. So we are taking the original £20 worth of gilts and repoing it to get £20, and until we have 100, we are 4 times levered. Let's suppose the gilt market falls 10%. Well, your equity, the £20 you put in, is now worth £10. The loss is, by virtue of your leverage, £10, not £2. Okay, had you just held the original gilts, you would have lost £2. If you are in this pooled fund, you've lost 10. Now, the question of how that can be described as risk management in the investment area is frankly beyond me, but it's being done. Now, that decline will result in a call of £8 from the manager of the fund in order to maintain the exposure of the fund. The £8 rather than 10 arises simply because what do you call it? The gilts have fallen by 10%, so you now have a smaller call than the £10 because your leverage is based on the values. Anyway, the fund has to sell with a 10% fall in gilt prices. The fund has to sell £40 worth of gilts in order to maintain its the decline in your equity means that the leverage has gone from 4 to 8. It's not actually 8, but it's close enough. The fund then has to sell £40 with gilts to restore the 4 times gearing. So there you are. That's the nature of the problem with pooled funds, and indeed with leverage in general terms. Repo is particularly sensitive to the short rate at rollover. If rates go up a lot, then your repo of a bond that you bought, let's say I bought my bonds last December, and I bought them yielding 1%. And this was fine for my first 6-month repo because the gilt I bought was 0.5% in yield terms above the repo rate. But now I still own my 1% gilt, but I'm trying to repo it in the market today, and I'm finding that short rates are 3.25%. So I am immediately losing 2.25% over the 6-month period on my repo. What we have just done is we have just transformed a stable long-term savings institution into a short-term institution with exactly the same sensitivities to short rates as the banking system has. Now, we've turned our pension schemes into banks without the salary structures associated with them. Of course, if you can't roll over, because even if prices have gone down, the amount of money you can raise in rollover is less than the last repo was done at, which means there's a cash shortfall. So you're going to have to find something to sell. And then you've got changes to initial margin requirements. Gilts at the beginning of this year, if your repo counterparty was charging you 0.5%, he was the exception rather than the rule. That's what the haircut tended to be. In the crisis, the FCA reported seeing haircuts in the 2.5% to 8% range. I have heard of people who couldn't get repo renewed at any price. Now, my question is, how can a trustee justify buying such a risky security? It's really, well, it's not a security, it's actually a transaction, an instrument. So, repo, economically, there's absolutely no doubt this really is secured borrowing. I mean, it's not legally secured borrowing because we passed the Financial Collateral Act in order to eliminate the possibility that repo would be considered secured borrowing. The risk that was being avoided there was this one. There's no registration of the charge with repo, when most repos are daily. To register a charge would frankly just not be practical. So the problem with that is that if there is no registered charge, the instrument can be recharacterized as secured borrowing, or not as secured borrowing as you like. But the point is that in bankruptcy, in insolvency, the liquidator or the administrator can actually require the collateral that was advanced to the bank to be returned to the general pool of assets for distribution to all creditors. And obviously the banks are not going to advance money on that basis. So a specific piece of legislation was passed to avoid the recharacterization risk. And that was done in Europe and transposed to the UK. Now, our repos used widely for financing long positions. It's absolutely clear that the repurchase leg satisfies the statute implied, and there is a specific restriction on borrowing that we will talk about later. But the point is, repo satisfies that. And there's an exemption for the use of repo or the use of borrowing by schemes rather than specifically repo. For short-term, schemes are allowed to borrow for short-term liquidity purposes. Yeah, I mean, if you want to pay the pensions today and your coupon's arriving on Friday, well, you can borrow the money from the bank and you can borrow it in markets if that's your preference. Just about every authority you look to says repo is borrowing. TPR said this: we understand, this is pure sophistry. The TPR is saying that repo financing, because it's structured as a sale and future repurchase of an asset, it would not amount to borrowing. Well, it's borrowing in all but name. It's certainly borrowing in terms of the spirit of the law. We've never managed to obtain a copy of the legal opinion which says that repo isn't borrowing, by the way. Ian and I accept that repo is not secured borrowing, but that does not mean it isn't borrowing. The Bank of England describes it just about everywhere as borrowing. So, what does the law say? Well, the relevant piece of law is actually the original IORP, the institutions for retirement provision, the European law. And that says that you can only borrow for liquidity purposes on a temporary basis. And schemes are doing this systematically. And it's been well known to the regulator that they have been doing it systematically. They've known it at least since the time of the 2018 Bank of England survey, or their own survey conducted a year later in 2019. Now, this is what the UK law says, and it's absolutely clear. Schemes may not borrow. Okay, and yet we're being asked to believe that repo isn't borrowing. It's quite bizarre, really, isn't it? The regulator recently, Neil Bull from the regulator, tried to claim that repo was a derivative. This is absolute nonsense. We searched and looked for papers describing, academic papers describing repo as derivatives. We found only one, and quite frankly, the quality of that paper is inferior to most toilet paper. EMIR describes it in this way. Okay, that's a derivative. Repo doesn't meet that criterion. Repos are not derivatives of the underlying, they are rather operations on those securities, their sale and purchase, for the purpose of borrowing money. The PPF did in one of its documents describe repo as a derivative. When I called them to ask them to explain that, they decided they didn't want to call it a derivative after all and removed it from the relevant document. So let's go on to the law regarding derivatives, because this is really rather important. And again, it traces back to the European law. And even though we've left Europe, this is still the relevant law. Okay. It says that investment in derivatives instruments shall be possible insofar as such instruments contribute to a reduction in investment risks. Now, these derivatives are being used to hedge a non-existent risk, interest rate risk, and inflation and various other risks, which are liabilities. So looking at the European law, it's absolutely clear that you can't do it. That's not an investment activity. The UK transposition of that law is this. The first thing to note is that the investment has disappeared in A, contribute to a reduction of risks. And B is simply an addition. Now, what's interesting about that is that in any serious court in this country, people will look to the original law and to the transposition. And you can expect them to strike out the words added and write back in the word investment. So almost certainly the operations known as LDI are illegal. So schemes are borrowing, schemes are hedging with derivatives, liabilities that is. Schemes are hedging illusory risks, that's discount rates. Schemes have become short-term market-sensitive institutions, supplying liquidity to markets when it is stressed and expensive, and they are doing it for free. It's the ultimate folly. Schemes are buying assets which increase the cost of provision. And this is a reference to the fact that the gilts, the index-linked gilts they so loved, they managed to drive to prices where the expected return on them was retail price index minus 3.2% in the 10-year. A certain loss. That means you are increasing the cost of pension provision, certainly. It made no sense, and I think it was probably ultra vires. Now, the collateral calls have been actually driven by the borrowing and derivatives contracts. And that led to the distressed selling of securities at a scale that disrupted the market. It's probably worth talking a little bit about this scale. The Bank of England showed 900 billion notional of derivatives back in 2018. The pensions regulators survey that was conducted for them actually has a lower figure, but most people put the level of interest rate derivatives between 1.4 and 1.6 trillion in the early part of this year. In addition to which, schemes owned about 500 to 600 billion of the outstanding linkers. Linkers of the outstanding gilts, both conventional and linker. So that's, roughly speaking, the size of the gilt market. And then you've got the pooled funds. Well, the pooled funds were variously guesstimated to have about 200 billion of capital in them, and to be levered, according to the pensions regulator, on average 4 times. So that's another trillion of conventional and linker, or gilt generally, exposure. So we now have 3 trillion of gilts controlled by the pensions world, when there are only 2 trillion or so of cash gilts in existence. Now, we've seen that once before. We saw that in the US mortgage securities markets, where the derivatives on mortgages actually were 3 times as large as the cash mortgage securities. And we know the result of what happened there. So when you have this high a concentration in a gilt market, if it all starts to do the same thing at the same time, the market is absolutely certain to collapse. And the question really then becomes only how much collateral damage gets done. And it really is as simple as that. And the collateral damage, I think, that probably spooked the bank into acting as rapidly as they did was the harm that was going on to the UK banking system. They are the counterparties to these swaps. Collateral calls were not being met. Those banks were worrying. The scale of the upsets and movements in prices also must have meant that the bank's authorized internal risk models would have all seen exception after exception. Most of the bank models now use 100-day averages. So you might be allowed 5 days of exceptions in that 100 days. Well, we just saw 6 days of exceptions in a row. So technically, those banks' internal risk models, which of course determine their capital adequacy, were no longer valid, no longer authorized. And that would have caused the banks to rein back dramatically the credit that they were offering. The banks were on the verge of having serious trouble. And that, I think, is what drove the Bank of England more than anything else. In terms of the pensions world, well, trustees should be around the risks. And I'm not sure that any of them have been. So too should the LDI managers, the investment managers. The law here is quite clear. The investment manager is as responsible for this as the trustees. And the idea that they can get away by saying, well, we were just doing what we were told, will not fly in a court of law. The more important thing is the pensions regulator has been encouraging this stuff. It's actually been threatening people who weren't doing it. I know of an instance where they went to the chair of the sponsoring company and suggested that a chair of trustees should be removed because he wasn't prepared to to move the scheme into LDI. So why did LDI catch off in spades? This is the reason, very simply. Until 2008, the acceptance and the take-up of LDI was quite modest. Then in 2008, we saw the collapse of short-term rates. I've used the 6-month rate here as my short rate, and the two gilts are the 15 and 20 year. The curve went from being flat to slightly inverted to being extremely steep and normally sloped. You could borrow money at less than 0.5% and buy a conventional gilt that was yielding in excess of 4%. Okay. And this is why schemes leapt on the opportunity to participate in LDI. It is, of course, pure speculation. You are financing a long-dated bond with a short-dated sum of money. So, let's tell you a good story. Why did sterling recover? Okay, it's really very simple. The people who were buying sterling here were pension funds. And these were pension funds who had been liquidating their overseas equity and other holdings and repatriating the money. And the reason they were liquidating those assets was they were damn near the only thing that they could liquidate in a hurry. And that caused sterling to rally. It's rather nice, really. Oh, the other thing to understand about why the gilt market was so fragile was, of course, the Bank of England had stopped quantitative easing, and they own about 32% of the market. And you've got foreign holders, overseas holders, who also own about 30% of the market. And of the cash market, 25% is owned by pension schemes. So between the lot, you've got 86 or 87%. When that 25% decides it wants to sell, there's only 15% available to buy it anyway, if they were all buyers. The fragility was eminently predictable. You can make this following case. The pension regulator did not understand leveraged LDI, did not understand how to regulate DB scheme funding, did not understand the difference between paying benefits when and as they fall due, and a valuation deficit. It basically proactively and naively encouraged the embedding of systemic risk, did not understand quantitative easing. And this is something which is really absolutely hilarious. The Bank of England was buying gilts in order to encourage people to buy other assets, corporate bonds, private equity, and whatever, high yield and growth assets. This was the idea of buying all of those billions of gilts that drove the bank. Pension schemes were not selling gilts, they were buying gilts, and they were selling other assets. So the pensions regulator oversaw a set of practices in the pensions world which were contrary to monetary policy and government policy, and didn't ever even mention it. So they absolutely encouraged and supported the introduction of leverage and the introduction of significant interest rate risk into pension funds, and encouraging to borrow at short rates and buy it long fixed. Encouraged and supported the introduction of rollover risk, the ability that you simply do not know if you're going to be able to roll over your repo when it matures. This is clear. The regulator, in my mind, is quite clearly responsible for the destruction of capital on a grand scale. And like the car illustration earlier, the absence of brakes and the presence of superior seatbelts leads to other design changes in the motor car. The motor car is made more resilient, but it doesn't give a shit about knocking down pedestrians or the harm to other people. And there has been a lot of harm done to other people. Mortgage rates went up probably 5 months before they would have done under the sort of schedule that the Bank of England was and is looking to raise rates on. The DC scheme members have been scared out of their wits. A friend of mine who's retiring at Christmas, saw his pot decline by 30% plus since the beginning of the year. He decided he couldn't afford to retire after all. So he went back to his employer and said, after I've done my Caribbean month in January, can I come back 3 days a week? Which he has committed to. There are no end of injury stories which can be told. Perhaps the one which has gone untold is the cost to taxpayer. We have seen the value of assets held by pension schemes decline by £500 billion or more, £500 billion, of which at least 20% certainly, was tax advantaged. That's the absence of taxes on the investment income and on the contributions made into schemes. So the members who, when they finally receive those pensions, and the current shortfall of assets is made up by either investment returns or sponsor contributions, will have received not 20% subsidy on their pensions, but 40. That's about 100 billion to you and me and out of our pocket. That's about a third more than Hunt imposed on us in his budget the other day. So the regulations state that the rate of interest, this is what you must do. This is how you get to choose the discount rate. My contention is very simple. If you eliminate the mark-to-market nature of the discount rate, you eliminate the motivation for LDI. And people can get back to buying equities and infrastructure and long-term productive investments, which of course is what we certainly want as a nation and certainly would like to prosper from as defined benefit beneficiaries. These are the rules. It says the return on assets held by the scheme. Well, there's a very simple situation here. It's say, well, fine. We just recognize the sponsor covenant as an asset of the scheme, which, as my earlier diagram showed, it clearly is. So it's not the albatross that should be penalized by higher funding requirements and similar things in the view of the pensions regulator. Then you simply return to the rate of return promised on contributions, which of course is the contractual accrual rate we mentioned. That is invariant unless you change the benefits. That removes the motivation for liability investment. And I think that's where the solution to this stuff actually has to end up. It's also open and transparent. It informs members not only of the contribution that is made, but also of the investment return promised. And that has been a significant lacuna in the DB pensions world. People think of their DB pensions solely in terms of the contribution made. They almost never consider the implicit rate of return on those assets. If we were to tell them both, we would be being open and transparent. And for this audience, that should be paramount. And with that in mind, I'll leave you with
Thank you.
this.
Oh, that's fantastic. That's absolutely fantastic. Please leave that slide there. Please leave that slide there because it joins the two worlds we're talking about tonight. The world of LDI and pensions and the world of IRHP mis-selling by the banks. Before we move on, can I please invite everybody to show their appreciation to what I personally think has been something of a masterclass into the nooks and crannies of LDI investing in pensions, and poses some very significant questions around: is it legal for pension schemes to borrow, and if not, why have they been? Did the pension scheme trustees fully understand what they were buying, and if they didn't, is that their fault? Did the investment consultants selling LDI in pensions fully understand what they were selling to? And the horrible question, of course, is what could have gone horribly wrong if the Bank of England hadn't intervened? What would the worst case scenario have been? With those thoughts in mind, let's first of all please show our appreciation to Con for presenting and preparing the session he's just delivered. Con, thank you very, very, very much indeed. Thank you very, very much. So Con's cartoon says, we structure the deal so it won't make any sense to you. And I think this takes us to the very heart of the topic. If we think of the Venn diagram I described earlier, one circle being LDI and pensions, the other circle being IRHP mis-selling by banks to businesses, the bit in the middle, the bit that joins the two, is, I believe, the mis-selling that took place.
Can I come in on one point which
Please.
I didn't raise in the course of that presentation? That is that the banks who were writing the interest rate swaps with dealers, with pension funds, were playing a very subtle game. Well, it's not subtle, it's very far from subtle. Let us suppose that when interest rates are 5%, I have roughly equal payoffs to the upside and downside of my interest rate swap as a writer of the swap. Okay, that's an even money bet. When I am writing a swap with a fixed rate of 1%, then the upside is somewhere between 6 and 8 times that of the downside. So even though they are fairly priced in the sense of the present value expectation of short rates to long rates is 0, the balance of win versus loss favors the dealer dramatically when you are at lower rates. And the investment consultants were encouraging schemes to invest ever more in IR swaps as rates fell. Have a little bit now and then put a bit more in next year and a bit more the year after that. And of course, this was going on at progressively lower rates.
Right. Thank you, Con. Thank you very, very much indeed. So let's focus on what I think is the key question here. Did the people buying understand what they were buying? And we're going to switch our attention now to the interest rate hedging product side of the equation. I'm going to ask a few people such as Andy Candy, Clive May, Mike Lloyd, Joan Finch, to very, 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 very quickly, we need to manage time quite tightly, very, very quickly describe as quickly as you can what happened to you in terms of what was sold. Could I please invite Andy Candy to go first, and then we'll go to Clive May, then to Joan Finch. Andy, then Clive, then Joan. Mr. Candy, could you please tell everybody as succinctly as possible what basically happened in your case? And I'd like everybody to listen to this, including the parliamentarians are here, because we really do think there's been a grotesque miscarriage of justice in the way that these interest rate hedging product mis-selling has actually been dealt with by the authorities at the time and frankly ever since. Andy Candy, over to you. Thank you.
Thanks, Andy. Just quickly say it's an amazing presentation by Con. My jaw was on the floor for most of it, given the figures involved. And clearly it looks like the banks have been, or whoever's been selling these has been targeting an area that it wasn't really required in, but have been creaming off a huge amount of profit at the risk of other people's expense. And similarly, the same was done to many thousands of SME customers over a decade ago, including myself, who bought a mortgage as part of a pension plan idea, but in wanting a standard fixed rate loan for that purpose, was in fact sold a step up interest rate swap. Not told about the margin accounting mechanism, not told about margin calls, initial margin, variation margin, anything like that whatsoever. And then when I came to develop my position and look at refinancing of the building and various other options, was told that I had to pay extortionate sums to break the swap in terms of a penalty that I had never been made aware of, or how it functioned over the term of the deal. And it looks like they've been doing very much similar things with these products.
Andy, thank you very much indeed. So, simple question: do you personally believe you could prove that you were missold? In other words, did the company that dealt with you withhold information that you should have known at the time the deal was done?
Yeah, the regulations are very clear. COBS 14.3.2 RD clearly states that the bank has a responsibility, an obligation to tell you about margin and other such obligations and risks, which include initial variation and obviously margin calls and other aspects. They also didn't tell me that what they were going to do to satisfy that was to set up a credit facility in my name, secured against my assets without my permission, which they kept hidden from me as an accounting practice, which they entered into their books and monitored. And every time there was a margin call in my situation when the base rate dropped, I wasn't told about it. They merely applied for extra credit from the credit team without telling me, and lumped that onto the debt that I owed to the bank, again, without me knowing. So I was basically put into a financial straitjacket where I couldn't effectively move my lending elsewhere, because other lenders knew that I had this massive liability. In addition to the mortgage of, say, $500,000, I had in excess of another 100 to 200,000 on top on margin, which I was not aware of. Now, any SME cannot run a business under those circumstances. It's physically impossible. So to have that concealed from you, and then by the regulator, which includes the likes of Mr. Bailey and Mr. Wheatley and others, is utterly appalling and abhorrent and sickening. And the fact that this situation is potentially playing out in slightly nuanced fashion within the pensions market, where you're looking at upwards of trillions of pounds, is just utterly sickening.
So we have, to my mind, thanks Andy, we have to my mind a relatively straightforward situation here. We've got businesses making a great deal of money, incentivized to make sales, and to make those sales withholding the full understanding from the client of the real risks involved, and in some cases, including Andy Candy's, deliberately withholding information and using all kinds of trickery. By the way, folks, the Transparency Task Force about 10 days ago submitted our evidence to the Work and Pension Select Committee's inquiry into LDI and pensions, and with the permission of that committee, we included some reference to the interest rate hedging product shenanigans by the banks. We are not able to share that document with you because it has not yet been published. However, I can say that we have a statement in it from a person whose job was to sell the very sorts of things that Andy Candy just been talking about, a confession, if you like, that this person was doing precisely what it is that Andy and many others believe has been going on. We have not been making this up. Andy Candy, before we go to Joan, I'd like you to very briefly explain what is BBRS and why is it not fit for purpose? Thanks, Andy.
God, you could fill a whole event with that topic. Effectively, it just, to be quite frank, it's just another stitch up on SMEs affected by historic banking misconduct and crimes, quite frankly. It was perfectly clear before it even launched it wasn't going to be fit for purpose. I've submitted documentation to it. I've been run around, and they've manipulated their own rules to effectively create an excuse to throw out my case without review. It's not run properly. The executive are dishonest. The staff are dishonest. It's an absolute aberration. I have no respect for them whatsoever. I mean, I don't have much respect for the FCA or the Financial Ombudsman Service. I mean, there's very little difference between them and the criminal banks that are perpetrating most of these crimes, quite frankly. The fact that most of them will probably be considered complicit in these sorts of crimes would not surprise me in the slightest. It's certainly my personal opinion. And yeah, the BBRS has taken whatever 2-3 years to get to gestation and has barely settled, I mean, a handful of cases, and I think one of those was £50 for inconvenience. I mean, it's a joke. It's a sickening joke on victims of crimes by banks, quite frankly.
The Transparency Task Force genuinely believes itself to be an evidence-based organisation. I promise everybody in today's session that I would not be allowing the comments being made, and I would not be making these comments myself if I did not believe it to be absolutely true. There has been something hideous going on in relation to the performance of the Business Banking Resolution Service. The session is being recorded. I'm going on record. I personally think that the Business Banking Resolution Service is not fit for purpose and would fail under any parliamentary scrutiny to demonstrate that it's been doing its job properly. And we have significant concerns. Mr. Candy, thank you very much. Joan, could I please invite you to very briefly introduce yourself and tell everybody a little bit, just a tiny bit, give everybody an overview of what happened to you and what you think of BBRS as well. And after Joan, we're going to go to Mr. Clive May. Thank you, Joan. You're on mute though, Joan. Thank you. Please take yourself off mute. There we go.
Sorry. Good evening, everyone. I really represent my husband and other members of my family. My husband and a number of other people, fairly ordinary people, invested some money, quite a fair amount of money, into purchasing a very large hotel in Greater Manchester in early 2008. They were advised by one of our high street banks, who were very supportive at the time, that yes, they could have a fixed rate loan. This was for 11.6 million. Unfortunately, they knew nothing, the directors, that this fixed rate loan actually had an embedded swap. My husband discovered about 15 months after the loan was taken out, when things weren't going quite the way they expected. They weren't getting the support from the bank. They were reneging on some of the advancement of further monies. And he said, well, I think we're going to have to move the loan elsewhere. And the managers said, no, you can't do that because there's a break cost of £1 million. The directors have not been aware of anything. They still did not understand exactly what was going on behind the scenes, because some years later, that break cost of £1 million was £2.5 million. And I have all the paperwork on this case, because my husband and one of our other businesses took the bank to High Court. I'm afraid we lost, understandably so. The bank denied that they'd ever sold an embedded swap. We had expert reports which the bank's legal team really stopped from getting into the court. So the judge really didn't see everything. The judge himself was rather hostile, obviously on the bank side of things. I was not involved directly in any of this, but obviously I invested money through my husband. We lost a tremendous business, a very viable business. In December 2013, the bank behind our backs sold the loan to Cerberus. They also sold personal guarantees, which in the bank's documents were said to be, said to have a value of nil. But when the bank sold the loan to Cerberus, they sold the personal guarantees to Cerberus as well. So my husband lost half our home. He had to settle, make a large payment after the court case to Cerberus. Obviously, everyone lost all the money that was invested. We lost the business. We lost money out of our pension fund and our other business that we'd invested. And we lost all, a lot, plus all the expenses of the legal side of things. And when you lose the case, you have to pay everybody else's legal expenses. So we thought that we would get justice in the court, but of course, knowing now in hindsight, that was never ever going to happen. But I can say, and I have a similar opinion of the BBRS as Andy Candy. It's been a huge disappointment. It's not worked. It's not independent of the banks. But what I did learn from preparing everything to take our case to the BBRS is I went through all our paperwork and I found two documents, two of the bank's documents that confirmed that we were sold an embedded swap. I hope that's okay, Andy.
It is, Joan. Thank you very much indeed. I know it's painful talking about all this stuff, but folks, people like Joan and Andy and the others you're going to be hearing from, Clive and others, have lived with this stuff for 10 years. It's been a cloud over their head for 10 years plus, and it's had absolutely devastating effects on their lives. And frankly, at the heart of it has been the fraudulent selling of complex derivative products to people that shouldn't have been buying them, being sold for one reason and one reason alone. They were massively, massively profitable for the banks, and the sales staff involved with the transactions were very, very highly incentivized to do so. Joan, thank you very much indeed. We're going to go to Clive May, and then please we're going to go to Mr. Mike Lloyd. So Clive May, then Mike Lloyd, and then Mike McGrath, okay? Clive May, Mike Lloyd, Mike McGrath. Mr. May, could you just briefly tell everybody a little bit about your case, please, just to give everybody a bit of a feel for what happened in your situation? Thanks, Clive.
Evening. Well, we didn't have an IRHP. We were taken out with a government scheme. The predecessor for bounce back loans, were basically what the bank did is they securitise their position by converting an overdraft using the government back guarantee where they got 75% of it. Unbeknown to us, one of our suppliers was credit insuring through Royal Bank of Scotland Invoice Finance. And we had a hidden credit line levelled against us that we knew nothing about. And that was what caused our company, along with the EFG, to cause the company to go under. Because basically the bank had £150,000 liability that they give to their client who was supplying us with materials. It was nothing to do with us, but they insured it and passed the liability on to us. So we had a hidden liability, exactly the same as in the swaps, where you got, break costs, but you don't know anything about it. I mean, it's akin to the next door neighbour insuring our car. We ended up with a liability. They're driving around in it. We don't know nothing about it. So the whole thing is an abuse of, in our case, the government schemes. They were trying to rip off the taxpayer. Indeed, RBS had to admit mis-selling this scheme that they took us out with to over 2,000 businesses. They were in the press saying it cost them 9 million, but it cost them a lot more than that. But to touch onto the experience of the BBRS, I mean, the BBRS is supposed to be an independent scheme set up to deal with historic complaints. Both me and my wife went through it. Although I had a small settlement, we were excluded on eligibility, but we were put forward as a concessionary case. And that basically meant that the evidence that we gave to the BBRS met the threshold. The problem was they had to ask the bank for permission. And the bank decided to say, no, we're not going to put you through. And that was the end of it. You know what I mean? It's like, you know, the Hillsborough victims having to go back to the police to see if they can get justice. I mean, you know, you never allow the perpetrators of crimes or wrongdoing to have a final say in someone to obtain justice. So, you know, and you know, my sorry tale is carrying on, and we've managed to have so much success in recently, and let's hope that'll come somewhere. But, you know, all the people that you go to, be it the FCA, be it the ICO, be it the SRA, all these people, they're all in a big club. And because we're victims and we're outside the club, we're painted. Our characters are basically told we're serial complainers, we don't know what we're on about, we're moaning, we're failed business people. We're the ones who are painted as the wrongdoers, as opposed to the people who actually carried it out. And I think that needs to stop.
Clive, thank you very, very much indeed. We're going to go straight from Clive to Mr. Mike Lloyd. Could you please introduce yourself, Mike, and tell everybody a little bit about your case? Thank you.
Hi, I'm Mike Lloyd. Myself and my ex-business partner, we had a successful public house build business, which we had 23 sites in total, 15 of which were freehold. And our borrowings in 2006 were around about 55% loan to value. I am not a spectacular, wonderfully bright and intelligent banking person. I can understand when I'm borrowing money how much I have to repay. But in 2006, Barclays Bank came to our office and told us that we needed to be hedged against interest rate increases, which they were very concerned that if they were to go up on our borrowings, which were £7 and a bit million, they explained exactly what it was all going to be and how much extra cost we'd have to go to. We obviously knew that if interest rates went up by 1%, we'd have to pay another £75,000 a year. Hindsight says that would have been a wonderful thing. However, they put us into a position that they enforced a condition that we had to enter into an interest rate hedge for 10 years, a minimum of 95% of all our borrowings. It wasn't a, we'd like you to do this, it was a compulsion. They didn't offer us a cap, they just offered us a structured cap and collar. Now, myself and my colleague, as far as we were concerned, we were told that this was there to protect us, and that was the end of it. We weren't going to be affected by any higher interest rate costs over above a certain figure. So we were forced into it. So that was all well and good until 2008-9 when interest rates collapsed. The first we knew about it was when Barclays removed a large sum of money from our bank account. When we tried to find out what that was, we were told that was the cost of the swap. What swap? We didn't understand it at all, but they said that this was the like the counterparty position. We had to pay them every month. Effectively, it became £35,000 a month, which we managed to do for 3 years. We disposed of various sites at the instruction of the bank to do this. We paid Barclays something in the region of 1.2 million, 1.3 million pounds in extra interest that we had to pay, and of course we had less money coming in because we disposed of the sites that we'd been forced to. The only way for us to get out of this was to buy ourselves out of the remaining 3.5 years that we had on the structured cap and collars, which we did at the end of May 2012. And to buy ourselves out of the remaining 3 and a bit years cost us £1,025,000. The first knowledge we had of any liability was when we were put into special recoveries by Barclays. And the special recovery team at Begbie's trainer, who we were obviously again paying their fees, subsequently became the administrator. That was nice and convenient. Barclays told them to add 1.8 million onto our liabilities, and that was the first knowledge we had of anything at all. 2 weeks after we bought ourselves out of the products that were enforced on us, we were placed into administration by the bank. 2 weeks following that, the FSA, as it was then, announced that the products had been missold. So at that particular point in time, we thought, well, that's at least good news. We can actually sort of try to work and resolve the situation and stop the administration. But of course, as time went on, we now know what went on behind the scenes. And in 2013, January, we were then effectively excluded from being paid compensation by the FCA because we were classified as sophisticated investors, which was just absolute damn nonsense. We were just two guys running a pub business, and we'd been running that pub business for, by that stage, 20 odd years. We had no idea at the time of the sale that there were any other liabilities, much the same as Andrew Candy's case. We were never told about any sort of colossal exit fees we may have to find. We were never told about the setting up of a credit facility in the business's name, secured against the profit. Sorry, against the properties. We were absolutely screwed. We had no idea whatsoever. Had we have been in the situation, we'd have had any idea. Never in this world would we have entered into that product. As far as BBRS is concerned, yet again, like the other people involved, specifically like Clive, we were also applying to BBRS. We were accepted by BBRS as a concessionary scheme, and that was put forward through to Barclays in December last year, and the bank rejected it, and the bank rejected it on the basis that our balance sheet was over their floor of £5 million. There's nothing like £5 million. Our balance sheet was about 1.3 million. But of course, they then advised us that they were working on gross assets. How the hell can any bank or any other business ever work on a gross asset position? Absolute nonsense. So yet again, we're excluded from any compensation under that scheme. BBRS is an absolute sham.
Thank you very much indeed, Mike. Later on, after we've heard from Mike McGrath, I'm going to be asking Baroness Bowles, if she's still with us, whether she would mind if we were to write to her about our concerns about BBRS, because I personally think the BBRS shenanigans needs to be something that's brought out into the open, so that parliamentarians can actually have a proper look at it. So Baroness Bowles, please be forewarned, I'm going to ask you if you would mind us writing to you about BBRS. Thank you very much indeed, Mike. We're going from Mike Lloyd to Mike McGrath. Mike, please introduce yourself and tell everybody a little bit about your case. Thank you.
Hi, my name is Mike McGrath. I'm from South Wales. I can't go into my case in detail because of legal reasons, but what I can add is that we were encouraged by a considerable amount of people to register for the BBRS, and myself, Joan, and a number of other Lloyd's ex-customers registered around about October, November 2019. And we actually got 107 of us together and agreed not to do, not to protest, not to do anything. We'd registered, go into the BBRS, and we would accept, obviously, a decision by the BBRS. But like many people, including Clive May and Mike Lloyd, even if you're presented as a concessionary case, you are then your case is then put forward to the bank in question. And I agree with the Hillsborough scenario, but I'll go a little bit further than that, because if somebody whacked my missus over the head with a hammer, and the gentleman's name was Peter Sutcliffe, and I had to go to Peter Sutcliffe and ask him if I could have his permission to take him to court for sticking a hammer in my missus's head, I think most people would be quite not only disturbed, but why would you even go down that scenario? And when you think about the banking issue at the moment, that's exactly what we're doing. Now, they actually made a decision on my case today, which happened to be regarding a particular event that happened 17 years, 7 months, and 17 days ago. 17 years, 7 months, and 17 days today on a decision that they knew that was wrong, but they have got the final say on whether or not the BBRS can look at it. So why are they going to look at something when why are they going to give their permission to the BBRS to look into something that they know they are guilty of?
Mike, thank you very much indeed. You make your point so well. Thank you very much indeed, everybody that's spoken in relation to the IRHP scenario. In a moment, if Baroness Bowles is with us, I'm going to invite Baroness Bowles to share her thoughts about what's been discussed today. I'm really pleased that Baroness Bowles has been able to join us. She is a very highly respected parliamentarian who knows a great deal about the workings of the finance sector, and she sits on the Industry and Regulations Committee, which has an interest in the sorts of things that we've been discussing today. But just before I go to Baroness Bowles, if she'd like to say any words, and perhaps let us know if she would be happy for us to write to her to set out our concerns about BBRS and related matters. I just want to kind of provide a few sentences to explain what we see. Within the Transparency Task Force, what we see is mis-selling of LDI to pension scheme trustees. Now, some of you may not know this, but about 8, 9, 10 years ago, I played a bit of a part in setting up something called the Association of Member Nominated Trustees. I was working for a firm of independent pension trustees at the time, and I and others could see that there were many pension scheme trustees who were ordinary shop floor workers whose job was to simply represent the interests of the pension scheme members. And there wasn't a community for those people, so we created one. We created something called the Association of Member Nominated Trustees. I think it was the first community I ever set up, and if you go to amnt.org, you'll find it. It's still operating today, and it's something I'm very, very proud of. The reason I'm talking about the Association of Member Nominated Trustees is because I think it's quite obvious to me that many pensions trustee boards who've bought LDI solutions will not have really understood what they were buying, and they would have been going on the trust and confidence they had in the investment consultants advising them to do this as a means to get rid of risk. Please see what I can see here, a parallel to exactly what was going on with these businesses who were borrowing money. They were sold the line, borrow the money, but you should take out this interest rate hedging product as well to lower your risk. In some cases, it wasn't even positioned as an option. In some cases, it was a compulsory condition. So we see this parallel universe dynamic between LDI in pensions and the IRHP mis-selling in SMEs. And what's even more tragic about the SME situation is that most of these dodgy transactions, and they were dodgy transactions, there is no real fight back that the sales were mis-sold. The tragedy is that these are open wounds that have not healed. There is still not closure. There are people who the system knows have been mis-sold, but have not yet put in place mechanisms to organise compensation. And I think personally, something really bad happened. The Financial Conduct Authority should never have allowed the banks to put in place a voluntary redress scheme. It's like saying to the burglar that burgled your house, if you want to be prosecuted for this, you can choose to be, but you don't have to be. What on earth is going wrong with a regulatory framework when the culprits are given the choice to pay out or not pay out? It just doesn't make sense. I genuinely think it's been a catastrophic and absolutely catastrophic regulatory failure. And here's a prediction for you. The moment there are sufficient parliamentarians who understand the truth about what's been going on, there will be serious action in the Commons to shine a big bright light on what's been going on. I'm going to jump to Sharon Bowles if you'd like to speak. Baroness Bowles, if you're with us still, please do share your thoughts on what you've heard tonight. Come at it from any angle you want, and over to Sharon. Thank you.
Well, yes, thank you very much. That comes as the end of quite a long day, one way and another. I'm quite envious because when I get to try to explain what's been going on in LDI, I get a whole 5 minutes in order to do it in a speech. So it's actually very good for Con to have sort of laid it all out like this. And I'm certainly going to make sure that there are other parliamentarians that I'll encourage to watch the video link when it comes, because as you say, it needs a more than sort of one or two to be going on about it. I think the LDI thing is probably going somewhere anyway, but there's a lot more wrong with it than most people can see. The mis-selling, which I didn't join in this expecting to, I didn't know that bit was going to happen. But I mean, it's just the same as we've had before with other mis-selling, where the FCA said things are outside the regulatory perimeter, and hence they encourage these voluntary schemes, and then as you pointed out very well, they don't work. So I think that is something that it does need to be looked at more. But I mean, I think a lot of these things, they're not just mis-selling, they're fraud. There's and there is a definite part of the Fraud Act that says that if you are using your position over someone else, then that is straightforward fraud. So really, I think there should be prosecutions, but of course we come to the point that of the higher standard, because it's a criminal fraud. But I think there should be encouragement to do that, because if you are literally conned into doing things by your bank that does have leverage over you in some way or another because of the services that they provide, then we have to have some major way of holding them to account. I mean, can you do a class fraud act? I'm just, class action fraud act thing. I don't know. It's food for thought, because I've just been looking at these kinds of things on the fraud committee, which has just issued its report. And of course we do. It's a very good report, but the trouble is we don't deal with fraud very well in the country at the moment. And I thank my lucky stars that I'm not one of the victims here, because I can remember, this was before I became an MEP, which was the start of my parliamentary career. So this was in the early 2000s. I mean, as a patent attorney, we do lots of foreign transactions, and I remember getting a fax from the bank wanting me to enter into all kinds of basically hedging things against currency moves, and it was only going to be available if I kind of signed it and faxed it back right at that point in time. And and they phoned up, and there was all this sort of pressure to do it, and so I told them to get lost, because I was quite happy at that time, because I actually personally tended to do the payments and keep on top of what was going on in currencies. But it would have been so easy just to sign it. And I said, well, I can't, I haven't got all of the information. Where's the details? What else? It was just a single page thing, but there were obviously other contractual terms behind it, which they point blank refused to give to me. And so, you know, I had no difficulty whatsoever in believing that those kinds of wrong practices have been going on, because I've personal experience of them. I didn't file it away thinking, aha, one day I'll be in a position to catch the bank out. Unfortunately, I wish I had. And I think that something does need to be done. So I'll you know, maybe we should try to get some committee in one house or another to have an inquiry on this. And we've got 4 committees at the moment that are taking an interest in LDI. But we you know, maybe among these somewhere we should also be looking onwards at what the banks are doing. I mean, maybe the Lord's Economic Committee is probably more in their remit. No, we could, but the trouble is there's always 200 things that you want to look into, and there isn't time for all of it. But by all means, write, and I'll make sure that people that I know see it, and some people that I don't know as well. Yeah, all power to what you're doing, and let's hope we bring an end to it, and maybe even get some satisfactory compensation somewhere sometime.
Baroness Bowles, we're very, very grateful to you. We will be writing. You've set aside a big chunk of your evening to be with us tonight, and I know that you were here because of the LDI, but your comments in relation to the mis-selling has been great to hear. I agree with you. This really does come down to deliberate trickery. Fraud seems to be the most appropriate word to use here. Can I please invite everybody to show our appreciation to Baroness Bowles, because there's just a chance that she might just help more than she realizes. And I assure you, Sharon, there are people here tonight who would give their right arm to the chance for justice. And by the way, it's not just the money. They've had their lives ruined for 10 years, and you would not believe what some of these folks have gone through. There have been suicides. I don't want to say any more than that, but it really is about as serious as it can get. Sharon, thank you so much for being here. Mr. Paul Carlier, we'll go to you. Then we're going to quickly go to Clive, and then we're going to go to Stephen Barker. Paul Carlier, thank you.
Yeah, I think one thing that I want to cover a few points. I want to start by explaining to you this. When I joined Lloyd's in 2012, as an experienced trader with 25 years trading under my belt, I discovered that myself and all fellow traders at Lloyd's, with all this decades of experience, we were prohibited by the bank from buying these types of derivatives. We were not allowed to buy them because of the risks involved. And yet they were, at the same time, they were selling these in copious amounts to SME customers. One thing that's come to light in recent weeks, and this is where the LDI and the discovery of it, the exposure is something of a blessing, or a mixed blessing, is that you're having all of these pension trustees and others and financial experts all saying, oh, we didn't understand these products. And there's acknowledgement across all sides that, yeah, these pension funds, as experienced as investment managers as they were, didn't understand these products. Yet a decade ago, the FCA and the banks would have us believe that all of these SME customers whose business involved nothing whatsoever to do with finance understood these products in their entirety and all the risks that came with them. And that, to me, is something that we really need to take away from this. And all that publicity surrounding the IRHP mis-selling to, or fraudulent sales to SMEs, all of that stuff apparently didn't educate anybody else when it came to these exposures later on. So the key thing that LDI has exposed is basically it's the mechanism of margin. And when I say exposed and brought this to the forefront, you see all these news bulletins explaining what's a margin call, what does it mean? Well, the reason that's happened to be explained is because that whole mechanism of margin was concealed a decade ago and longer when it came to the selling of these products. Now, if you want to sell, the banks realised that sell somebody a fixed rate loan, there's an X amount of markup and profit that can be enjoyed. However, if you recreate that or involve a few different component parts and moving parts, you can make something appear to do the same thing, but at the same time, you're making a markup on all these moving parts. And you can even make that product, like a collar, you can make it come with a zero upfront cost. And the reason is because behind the scenes, they're fiddling around with the strikes on these two components, and the bank can make double the money by selling a collar, but make it look free up front to the customer. So, but the only way they could do that, and they had a major problem, was, okay, with this, we have to do a contingent liability calculation. That is basically our calculation that determines what our counterparty risk is if we sell that product to this counterparty. So they would say, for example, okay, and I'm going to use an actual case study. An SME customer had a 20 million facility, and the bank determined that they did a contingent liability calculation, determined that they would require the contingent liability or the risk that they then faced was 2.4 million. So that contingent liability figure calculates that risk as potential risk as 2.4 million. That would then in turn determine the initial margin that would be required. Now, the initial margin is a requirement, and it is a requirement whereby the bank goes to the customer and says, right, you have to give us 2.4 million in cash or other collateral, or we can't sell you that product. Because that contingent liability calculation that determines the amount of initial margin is basically designed to mitigate the bank's risk. So in other words, we need to reduce our risk, our counterparty risk, by demanding 2.4 million in cash from the customer. Now that's a problem for the bank, because this customer would only make a £10,000 saving if they bought this collar versus the caps, but the bank would make 130,000 profit as opposed to a 70,000 profit. So how do you convince that customer to go for this product, which would save them £10,000, if you then had to say to them, oh, but if you want to enjoy that 10,000 saving, you've got to give us 2.4 million in cash for 5 years. All right, what customer's going to go for that? They're not. So what they did instead, they conceived a way around it, or to circumvent it. So what they did was, you've got ledger A in the bank's books that is saying, right, we want 2.4 million cash here, to satisfy this initial margin requirement. What the bank was essentially doing was borrowing the 2.4. They created a credit line in the name of the customer, and they borrowed that money in the name of the customer from ledger B, and then stuck the credit 2.4 million value of that into ledger A, so that ledger A looked like it had satisfied the initial margin requirements. But what you now had is a situation, and this is where it becomes fraud. And a criminal barrister said to me in 2017, you can't plead fraud in these cases, it's locked in as mis-selling. When I explained this whole process, he reversed his position and said, in that case, it is fraud, because it was fraud by false representation with intent to make financial gain. Because having created this credit line to satisfy this initial margin requirement, what had the bank done? Instead of reducing the bank's counterparty risk, which is the sole purpose of initial margin requirement, the bank had increased their counterparty risk, because they'd now given the same customer another 2.4 million credit line. So instead of reducing your counterparty risk, you had knowingly increased it by giving the same customer another credit line. So initial margin requirement has but one purpose: reduce the bank's counterparty risk. But by doing that and asking the customer for the cash, that they're not going to sell the product. So they instead increase the bank's counterparty risk by taking out a credit line for that value over here and sticking it in ledger A. Now, the other problem they've got is that, well, how do you get around? We've got to tell the bank this, because it's a regulated product. It's under MiFID. This is a product that exists entirely because of an FCA regulated derivative. So we have to disclose this. No, we just won't, because we just won't tell them. So they literally concealed the existence of the credit line as well. So a credit line that shouldn't exist in the first instance, they then sought to further the fraud by concealing the existence of it in the second instance. So the whole thing is, and they thought they would get away with it because they've been selling some of these products for a good decade, and interest rates had moved proportionately within a relatively tight margin. So it's only when things then come outside the ordinary slightly that all of a sudden these things are exposed. And that's what happened obviously with the financial crisis. But the whole thing here is that there's a really important case in case law. It's Crestsign versus RBS. John Swift relied upon it in his report. And in that, the experts representing Crestsign agreed with the bank experts that contingent liability was nothing to do with the customer, bore no relevance to the customer whatsoever, just an internal calculation that had no bearing and no relevance to the case. So therefore that matter is excluded from the entire argument. But it was the entire argument. And the experts that agreed that, how could you possibly agree that when you know that that contingent liability determines the amount of initial margin that the customer must be asked to put up, and in the absence of that, what the bank was doing was obviously deceitfully taking out this credit line. Now, I told John Swift's support team of a discovery I made when I was at Lloyd's, and I'm not going to go into too much detail here, but one thing I can say for sure is that Crestsign judgment, which all swap mis-selling claims fall foul of, because they found in favour of the bank, it was obtained in no small part due to the non-disclosed conflict of interest. The experts representing Crestsign were experts that had advised multiple Lloyd's Bank customers that the toxic collar they were sold was appropriate. Now, therefore, that advisory firm has a vested interest in RBS winning that case, because if RBS loses that case, it means that that bank that was involved in selling this toxic product to the customer is now liable for a substantial compensation payout. Well, also, so is any expert advisory firm that advised customers that these things were okay. So, and that firm did not disclose that it had a conflict of interest. And that firm inconceivably agreed that contingent liability wasn't relevant to the case, which is absolutely untrue. So, and although RBS won the case, and Crestsign, they then settled with Crestsign immediately afterwards. So the Crestsign didn't bother to appeal it. Well, yeah, but RBS now had this judgment in the books that everyone else has relied upon since. So there's a whole issue there, and that brings us on to the Swift report. And I've put some certain things out there, and once we get this judicial review out of the way, I'm going to reveal some home truths about how that the Swift review, not John Swift himself, but I have severe questions as to the support team, Ashurst and Monkton Chambers. I've got evidence to more than suggest that I was dishonestly triaged out of the investigation by that support team, so that I never got to see John Swift and present all the evidence and testimony that I gave to the support team. I've got the email sent to him immediately after my meeting where they told Swift that there was no need to meet with me. And the description of me, my testimony, my evidence in that email is, and I'm going to say it here on the record as well, like Andy did, it's a fraudulent misrepresentation of me, my testimony and my evidence, but it served to basically convince John Swift he didn't need to see me. And much of what is in the report, my evidence or testimony challenges it or contradicts it, or raises very serious concerns. And Mr. Swift doesn't opine on any of that. So it's fair to say someone in Mr. Swift's position would, when given evidence that contradictory evidence or evidence that contradicts each other, he would review it and explain why he chose to believe that evidence over the other evidence. So he would put all the evidence that was before him and then explain why he chose to follow that. He doesn't reference my evidence. So
I think you're absolutely right, Paul. I think there's probably, I won't mention names right now, but we think there's probably at least three, possibly four people who gave evidence to the John Swift inquiry that Mr. Swift did not see. And
if I can, Andy, John Swift wrote to me when I wrote to him saying I was a former director of Lloyd's Bank. I worked on the trading floor where these swaps were sold, 25 years working on trading floors for all of the world's largest banks and trading these very products. He said, yes, I'd be really keen to meet with you. He wrote that to me personally, suggested having a preliminary meeting with his support team. I had that preliminary meeting. I sent him 4 or 5 emails beforehand with all of this smoking gun evidence, if you like, Lloyd's pricing policy, which is a key thing, Lloyd's Project Gresham document, which was the document used by skilled persons, and a whole variety of other evidence. And I summarised it very briefly, discussed it at the meeting, and I've got the transcript of my interview with his support team, where the description of my meeting could not be further from that. And it's quite clear to me that my testimony challenged, let's just call them desired narratives, certain desired narratives. And as a result of that, I was then deprived of my meeting with John Swift. And so were 3 other experts that I know of who presented similar evidence, similar testimony, and similar positions based with similar kind of experience. All of us were told we're going to have a meeting with Swift. All of us were ultimately deprived of it after the meeting with the support team.
Well, thank you very, very much indeed for sharing that. Remarkable, truly remarkable. We're going to go to Clive May, then to Stephen Barker, then we'll open it up. Mr. May, thank you.
Just touching on something the Baroness mentioned, considering that the FCA have seen my case, Andrew Bailey personally, the British Business Bank, the government BEIS department, they commissioned a report into my case. Royal Bank of Scotland and various other people all said there was no evidence of fraud. First time we presented it to a criminal judge, he agreed with us to sanction the summary on 3 counts of fraud. So why is it a criminal judge can see the wrongdoing, yet the people who are supposed to oversee this all want to shut up shop? So we're now faced with a private prosecution against individuals that, it's going to cost us quite a bit of money. But at the end of the day, someone's listened to what we were saying and has agreed that what we were saying was right. The evidence was presented to them and they sanctioned it on fraud. So the criminal route is the way to go. And then the Baroness is absolutely right. And if you could do a class action for fraud, which would be difficult because it has to be mens rea of each people that are involved against specific cases. PPI is probably the closest you could get to a group action on fraud, but of course, the classed it as mis-selling. But the only way we're going to get justice is in the criminal courts, where the banks and the regulators and the rest of them who can't control that, the true evidence will come out and be seen. And, the Baroness is right. Yep, criminal courts is a place.
Clive, you said something earlier that I'm only just really now understanding, and you made reference to Hillsborough. And I'm really understanding why you mentioned that. The systemic failure to do the right thing for many, many years. When the final report eventually came out, it was just shocking. It was shocking. And I can honestly see parallels between that horrific set of events and what you're talking about now. And you know what? I wrote something about the FCA a little while ago. I referred to the FCA being morally bankrupt. And some of you might remember it. It's when John Swift KC, I think I'm right in saying, the FCA's non-exec directors asked John Swift KC to look into the interest rate hedging product mis-selling stuff. I think he and his team spent, was it 2 years doing the report? It cost over £7 million. And the central finding from that was that the FCA should mandate the banks to pay the compensation. It should have been a done deal, The independent adjudicator says, I've refereed the match, X, Y, Z did something wrong, yellow card, red card, off you go. But what did the FCA do? The FCA did, it decided not to do it. And what then happened? We have Kevin Hollinrake MP and the other members of the all-party parliamentary group on fair business banking saying, we're not having this. These are my words, not theirs, okay? But the narrative was, this is bang out of order. This is bang out of order. The system knows these people are being, excuse my language, Baroness Bowles, shafted, and the independent adjudicator has said, this ain't right, make the banks pay them. And the FCA turned around and says, no. And what do we end up having to do? We end up running around for 4 months to raise £100,000 for a judicial review. We've now got parliamentarians, the all-party parliamentary group on fair business banking, attempting to execute a judicial review. The law firm Hausfeld, bless them, have done a discounted rate. It's only going to cost 100 grand. We run around for 4 months getting the pennies together to get the 100 grand to pay them. We've got parliamentarians whose essential purpose in life is to represent the interest of the constituents, taking the conduct regulator to court because the conduct regulator has decided to not comply with a report produced by an eminent KC that basically says, FCA, you're wrong. Now go and make the banks pay. On top of that, we've got reports in the Times from James Hurley proving there was collusion by the Treasury and the banks to minimise the amount of compensation the FCA was going to make the banks pay. And quite miraculously, the FCA said, no, 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 no. There was pressure on us to reduce the amount of compensation. We did decide to reduce the amount of compensation, but it had nothing to do with the pressure that we were put on. And it's out there in the Times. That's why so many people are losing trust and confidence in the Financial Conduct Authority, because whenever it's a 50-50 ball, it's the bad guy that gets the decision. It's tragic. We're going to go to Stephen Barker before I get myself too upset. Stephen, please introduce yourself and say a few words. Thank you. If you're still with us, Stephen, are you? I think Stephen is. You might be on mute, Stephen. Yep, Stephen, you're on mute if you're speaking.
There we go. Sorry about that. Technology, marvellous. I'm going to just take a slightly different line because we have the benefit of Baroness Bowles being on this call. You mentioned in your comments about the regulator, the chief executive of the regulator, talking about perimeters. And I felt over the recent years, the numbers of times that Mr. Bailey has appeared in front of various committees of Parliament and has effectively blamed Parliament for the inadequacy of the legislation referring to the Financial Services and Markets Act 2000. Now, I'm watching this on television. I'm not able to join the game, but I have to say that Mr. Bailey and others, banks in particular, who've said, we've done nothing wrong, that's what the legislation says, they are completely wrong in their observations. The Financial Service Markets Act was a very, very comprehensive and robust piece of legislation. And it wasn't suddenly dreamed up one day because a few parliamentary members thought, you know, we need a new Financial Service Markets Act. It came about because of a whole series of major financial incidents in the 1990s, which was really no different than what we've experienced subsequently. I'm particularly thinking of the way that banks targeted local authorities to sell them derivatives in the 1990s. It got to the state where quite a few local authorities were technically insolvent as a result of these sales practices. Now, local authorities in the UK, unlike America, they can't become insolvent. Effectively, the government has to step in under the Local Government Act and you know, be responsible for them and provide them with the necessary funds to continue their statutory duties. Fortunately, we had then the Local Government Act of 1972, which was very restrictive on what a local authority could do. Very precise piece of legislation. In other words, they hadn't got the general power of competence which they currently have under the 2011 Localism Act. They were very restricted. And so fortunately, the local authorities who were affected, they were able to take individual banks to court. And of course, the leading case arrived at the House of Lords, having gone through the appeal court, House of Lords as it was then, before we had the Supreme Court. And the House of Lords were able to say in that case, it was Hammersmith, London Borough, they were able to say in that case, the council, the local authority, did not have the power, capacity, so the technical term is legal capacity, to enter into these contracts with these banks. Therefore, those contracts are unenforceable and void. You will put everybody back into the position they were in before they entered into those contracts. And that's the essence of restitution. So that might mean that the banks have to pay the local authority certain monies back, and the local authorities may still have to pay the banks some monies because they might have received some monies from the bank under the contract terms. So everybody's put back to where they were. And as a result of this experience and other similar incidents with banks, we have the Financial Services and Markets Act 2000. It took a long time for Bailey to accept that derivatives was actually a regulated activity. For a long time, he held the position that this is outside the perimeter of the activities of the FCA. I mean, if it was different, we'd behave differently. But actually, eventually, he had to concede that it was a regulated activity, but it didn't make the slightest difference to what he did. And for parliamentarians, I suggest that this is a real threat to Parliament. If you have institutions operating in this country in defiance of the legislation that you have passed in Parliament, that's got to be completely unacceptable, completely. And unfortunately, we don't talk to these agencies in the way that we should talk to these agencies. They're acting on behalf of Parliament. They are part of our state structure. And it's critical that they are above criticism. They have to be. And to be above criticism, they have to comply with the legislation that's created them, which I understand the courts describe them as creatures of statute, a phrase to mean you only exist because the statute exists. And it's an important area of this whole debate. And so for parliamentarians to be hesitant about getting involved, I think is misguided. They've every reason to get involved. This is Parliament's legislation, and it is being abused by agencies like the FCA, individual banks, and the executive, which is the government of the day. Her Majesty's Treasury is part of the executive, and for them to be, even to be suggested that they're involved in any kind of collusion or cooperation or blind knowledge is just unacceptable, I would suggest.
So something
of my observations. Thank you.
Thank you for sharing those thoughts. We're going to throw it open in a moment, folks. Just before we do, I want to add an example to what Stephen has just been talking about. I believe I'm right in saying that on 14 occasions, Parliament has discussed the idea of a duty of care, essentially the idea that the financial services sector needs to be legally accountable for any malpractice, and if people have been harmed in a foreseeable way, they have a right in law to have a go to get compensation and justice, etc., etc., etc. 14 times, I believe, in the last roughly 10 years or so, I think it's been raised in Parliament. Under the 2021 Financial Services Act, Parliament mandated for the FCA to consult on a duty of care, a legally enforceable right. We kicked up stink, we being TTF, because they didn't do it. the FCA consulted on a consumer duty, which is essentially treating customers fairly in bold. That's basically what it is, but it's not a legally enforceable right. We actually believe the FCA deliberately snuck through in a really cunning way, a watered down thing called a consumer duty. And by the way, the Bar Council, the trade body of the barristers, wrote a brilliant piece. I'll put it in the chat if I can find it, basically saying, no. You can't call a consumer duty a duty of care. It's an entirely different legal thing. I'm just making this point because it's a really good example of how, quite astonishingly, the will of Parliament is not being acted, and it's really worrying. You then end up sort of waking up in the middle of the night and thinking, what's happening to our democracy? And you end up pulling your hair out and getting really quite upset. Before we go to anybody else, could I just invite, if you'd like to, Baroness Bowles, any further comments from you before we go to anyone else? Thank you.
Yeah, well, we have noticed about the duty of care issue and complained bitterly about it to the FCA and elsewhere. And we will be attempting to introduce amendments into the latest Financial Services and Markets Act when it comes to the Lords, and I presume we'll get the same cross-party support, though I imagine that the government won't let us have it this time, but we'll certainly be making a fuss about it. But I mean, I've got ideas about quite a lot else. I mean, I want to put the relevant bit about abuse of position from the Fraud Act. I want to try and think of a way to formulate that so that the FCA have to take action, and there are various other things like that. But we know that the government will whip their troops to oppose these things by and large. I mean, that's the trouble. Government is complicit in these things, it's very difficult unless you can get cross-party support in a select committee to really push hard on one or two things. But the trouble is, there's about 100 things that are wrong, and we just can't get to all of them. I mean, I'm sure the committees are all going to be very critical of things like LDI, but you know, will anything actually happen? Well, it might stop now that the insurers have decided they can't make that much money out of it that way round. But I mean, I think that doing, I mean, I want to take away the notion of the regulatory perimeter as well. You know, so that anything that, you know, any purveyor of a financial product that does harm to another should be capable of being prosecuted or being pursued by the FCA. That's what I think it should be. That doesn't mean to say that every single purveyor of every single thing is going to be supervised. They may not be supervised, they may not be authorized, but if they're messing around in financial services and flogging it to people, you can't leave it with a buyer beware. I mean, that's just not adequate. And it's not adequate for SMEs. And frankly, I don't even think it's adequate for big companies either. When you look at, you know, you can't say a pension fund or some of these big pension funds are small, or that their employers are small. But I reckon they've probably been bamboozled by this whole, you know, using standards and looking at liabilities and all of these other things. They've been led by the nose through it. Without anybody there to put forward an opposing view. So I'm probably going to have to call it a day at this point, because I've got I think I've got a board meeting coming up and I should be reading the papers. But by all means, write and inform me, and I'll circulate further. But I mean, I know you know that there are quite a lot of parliamentarians who have been in the Fair Business Banking and other APPGs are interested in these things, and we've just got to keep at it. And thank you everybody else for telling your stories. And I really feel for you, and I hope that I can make a difference, and along with colleagues.
You already have. You've given us a sense of hope. You've given us a sense that somebody out there is willing to listen, and that's priceless, Baroness Bowles. It really is. Can we please show our appreciation to Baroness Bowles? Thank you very, very much indeed. Thank you. Thank you. Thank you. Thank you. Thank you.
Okay, thank you very much.
Good night. Good night.
Good night.
Wonderful, absolutely wonderful. It does give you hope, folks, doesn't it? It really does give you hope. People who understand, understand and care, and are in a position to potentially do something. I'm just blown away by the supportiveness shown. I really, really am. Would anybody else like to come in at this point, folks? Just wave your hand, either digitally or literally. Would anybody else like to come in at this point? I'm losing my voice. It's been a long day. Mr. Nigel Cairns, what are your reflections from tonight's session, sir? Thank you. Nigel, take yourself off mute. Go on, that's it. Just briefly, your reflections, Nigel, just briefly.
Well, an immediate few words by Baroness Bowles. They're just very encouraging that, you know, the clarity of understanding that does exist. You know, we all get to the state where we think, is anybody listening? And clearly some people are. And clearly understanding very well what the nature of the problems are.
Yeah.
And also, I'd like to reinforce Stephen Barker's viewpoints that he made towards the end of his speech, which have just gone completely out of my mind. But
it's been a long day, Nigel. Don't worry. Don't worry.
Yeah, but I very much agreed with the sentiment of what you were saying.
Whatever it was you said, Stephen, it was good.
Yeah.
Good man. Thanks,
Don't
Nigel.
forget to vote. No.
Thank you very much. Would anybody else like to come in?
I was just going to make a very brief comment, Andy, to say it was interesting that Steve brought up the Lobos, which I think were the products sold to the councils, and obviously underlined by derivatives. So we've gone through this whole process of these products, absolutely cancerous products, totally unsuitable, being sold to local councils, getting caught out, getting shopped for it, getting told to sort it out, selling it to SMEs, but getting away with covering up the fraud of margin credit accounting. And then you've got them then literally in the same decade that they're covering that fraud up, they're purloining these onto the pension funds. And if I've understood, being a graphic designer, obviously a lot of what Con went into, which was astounding, but effectively it seems that they've persuaded the pension funds to hedge a variation risk that doesn't really have a big impact on their product. But obviously for the banks and the leverage that's then applied, the profitability, I think in one of the articles I see that Legal and General, I think, may have made something like 80 million or more in 1 year on these products. So to say that there's no incentivization for them to missell these products to pensions and what they're creaming off, and Lord knows what they're doing on the leverage side of it, is just astonishing. And yet here we are with Andrew Bailey and the FCA and everyone trying to say, oh, they're not derivatives, they're insurance products. Oh, they're not derivatives, they're not lending. They're denying everything, but the plain truth that sits in front in the regulations, as Stephen pointed out, in the FSMA, in MiFID, it's there for everybody to see, and yet it's like the emperor's new clothes. Oh, we can't possibly say anything or upset this or upset that. It's an absolute nonsense. And it's such a blatant fraud that is backed up by extensive amounts of documentary evidence. Not one single customer, I guarantee you, that went through the FCA review or was excluded from it, had any notification about margin, variation margin, accounting margin, the margin calls that happened inevitably as the base rate dropped. They weren't kept updated. They weren't told that a credit was being issued in their name as a result of that, and that effectively that's what ended up putting them into either administration or charged extortionate amounts of break cost fees. And yet here we still are, and they've, you know, now perpetrated it on pension funds, and it sounds like there's obviously a lot to unpick there. But it's like, when is actually anybody going to get hold of these, quite frankly, cowboy criminals in the city of London that are perpetrating all of this? Because to my mind, Andrew Bailey seems to be right at the centre of it, and it's like, well, what are you doing about it?
I'll tell you what it's like, Andy. Thanks, very, very well said. I'll tell you what it's a bit like. Do you remember when we all used to smoke cigarettes, and then we eventually realised it was a bad thing to do, and then they stopped us buying them, or they put warnings on, etc., etc. So we went from we didn't know they were poisonous to we knew they were poisonous, and then gradually we kind of got rid of them out of society to a large extent. But what did the tobacco companies do? They went and found other places to sell them, India and the Far East. Yeah, they deliberately moved the sales channel to other parts of the world that hadn't kind of caught on to the same extent that we had, that these were really bad things to do. So think about it. You're the marketing director of a great big cigarette company, and your job is to find ways to sell this stuff. You know the cigarettes are lethal, literally. You can't sell them in your home countries or your home territories. So what do? You don't resign and think, I don't want to do this anymore because I now know this stuff's rubbish and poisonous. You go and find other countries to sell them in exactly the same way. Derivative selling by banks to SMEs has moved from that territory to the world of pensions. It's just grotesque, isn't it? You know, it's just disgusting. Excuse me using strong language, but it just is. Would anybody else like to come in? Otherwise, we'll start bringing this session to a close. Joan, please do take yourself off mute first. Thank you.
I just wanted to say earlier, I think Paul was talking about the SWIFT report, and I believe from what I've heard from the experts that we all know, and we're very lucky to have around us, that the SWIFT report didn't really cover the derivatives that were sold in the fixed rate loans and the tailored business loans. That's all I wanted to say.
That's right, absolutely right. The scope didn't cover it. Absolutely, Jane. You're right. Would anybody else like to come in now? Okay, well, we're just over an hour, over session. Looks like I've managed the timing on this one as well as I normally do. Forgive me, folks. Forgive me. It's been a long old day, but I genuinely believe we're making some progress here. Hopefully, I'm not going nuts and I'm not making.
I think that was Paul's segment, Andy, that took us over. He'll kill me for that, but I'm sure.
Oh, bless him. It wasn't actually. It was multiple places. I know you know. I know you know. So I guess we could end this with let's end this on a positive. Where there's a will, there's a way. There we go. You've heard that one, haven't you?
Yeah.
There's a will, there's a way. Onwards and upwards.
Not at all.
All right. Good night, everybody.